Dividend investing may sound slow, but with the right strategy, it could be the fastest route to millionaire status. Dividend investing is one of the best kept secrets in the financial world, and it's surprisingly straightforward. Imagine getting paid just for holding on to stocks. That's exactly what happens when you invest in companies that pay dividends. Dividends are regular payments companies make to their shareholders, sharing a piece of their profits with you. Now, you might wonder why dividends matter. Well, they're not just small bonuses. They're actually a powerful way to build wealth over time. Instead of relying on stock prices to go up, dividend investors collect steady cash flow, which can be reinvested to buy more shares. Over time, this cycle can lead to significant growth, especially with the magic of compounding. So, whether you're new to investing or looking for ways to make your money work harder, dividend investing could be your path to financial freedom. Let's explore how this strategy can change your life. Chapter 1: Misconceptions about Dividend Investing. Many people think dividend investing is slow and only for retirees, but this couldn't be further from the truth. In fact, dividend investing can be a powerful wealth building strategy at any age. One common misconception is that it takes forever to see results. Yes, dividends do grow over time, but that doesn't mean you're just waiting around. Every dividend payment is a step toward financial independence, and reinvesting those payments can speed up your progress more than you might think. Another myth: that high-yield stocks are always better. While it's tempting to go for stocks with big payouts, they often come with hidden risks. High-yield stocks can mean the company is struggling, or they might not be able to maintain those payouts in the future. A sustainable yield is often a better choice, with companies that show steady growth and financial strength. Finally, many think that dividend investing isn't worth it if you're young. But starting early actually gives you a huge advantage. With time on your side, you can ride out market ups and downs, letting your dividends grow and compound. So let's leave those misconceptions behind and uncover what truly makes dividend investing a smart move. Chapter 2: 3 Types of Dividend Investors. When it comes to dividend investing, not all strategies are the same. In fact, there are 3 main paths that dividend investors typically follow: high yield, growth, and hybrid approaches. Each has its own benefits and challenges, so let's break them down. First, there's the high yield path. This is where investors focus on stocks with large dividend payouts. While it sounds great to get big checks regularly, high yield stocks often come with higher risks. Some companies offer high yields because they're in a less stable financial position, so those big dividends may not last forever. Examples include companies in traditional industries like utilities or telecommunications, where cash flow is steady but growth may be limited. Next is the growth path. Investors here look for stocks with smaller dividends but higher growth potential. Think of companies like tech giants that pay modest dividends yet have plenty of room to grow. These stocks can be more volatile, but they also offer the chance for significant appreciation over time. For those willing to ride out the ups and downs, growth-focused dividends can be quite rewarding. Finally, we have the hybrid path. This approach combines the best of both worlds. Hybrid investors look for stocks that provide a moderate yield with decent growth potential. They aim for balance, often choosing companies with solid financials that pay reliable dividends, but still have room to expand. Many people find this path appealing because it offers steady income without sacrificing too much potential for growth. So, whether you're after big payouts, growth, or a blend of both, knowing which type of dividend investor you are can help you build a portfolio that suits your financial goals. No matter which path you choose, the key is to stay informed and pick companies that align with your investment style. Chapter 3: The Secret to Successful Dividend Investing. The secret to successful dividend investing isn't just about chasing the highest yields. it's about finding quality companies that happen to pay dividends. Here's why this approach works so well and how it can transform your investment strategy. Instead of focusing solely on a company's dividend yield, look for businesses that are strong, stable, and growing. These are companies that dominate their industries, adapt to changes, and consistently deliver to their shareholders. For example, think of companies like Visa and Apple. Both pay dividends, but they're also leaders in their fields, with strong track records of growth and innovation. Another key factor is a company's balance sheet. You want to invest in businesses that are financially sound, with little to no debt. This financial strength means they can keep paying dividends even during tough economic times. A clean balance sheet can give you peace of mind, knowing the company has the resources to weather market fluctuations. It's also important to consider brand reputation. Companies with strong brands often have loyal customers and steady demand for their products. This stability supports consistent earnings, which in turn supports regular dividend payments. Take Coca-Cola or Microsoft, for example. These companies have iconic brands that people trust, making them solid picks for long-term dividend investors. Finally, remember that dividend investing is a long game. By focusing on quality companies with good fundamentals, you're building a portfolio that can grow over time, providing steady income and the potential for capital appreciation. Dividends might be the icing on the cake, but it's the strength of the company underneath that makes for a satisfying investment. So the secret is simple. Prioritize quality over yield. Look for strong, reliable companies and let their dividends reward you as they grow. This approach not only helps you build wealth, but also gives you a smoother ride along the way. Chapter 4. Building a diversified dividend portfolio. Building a diversified dividend portfolio is essential for managing risk and maximizing returns. Instead of putting all your eggs in one basket, you want to spread your investments across different sectors and types of companies. This way, if one industry takes a hit, your entire portfolio isn't dragged down. A great starting point for diversification is using dividend-focused ETFs, or index funds. These funds invest in a broad range of dividend-paying stocks, giving you instant diversification. For example, an ETF that tracks dividend stocks across various sectors like technology, healthcare, and consumer goods can provide a solid foundation. It's a simple way to spread your investments without having to pick individual stocks yourself. However, if you prefer choosing individual stocks, aim to include companies from different sectors. For instance, you might have Visa from the financial sector, Coca-Cola from consumer goods, and Johnson & Johnson from healthcare. This way, you're not overly reliant on one particular industry. Diversification also means balancing different types of dividend stocks. You can have a mix of high-yield stocks, growth-oriented dividend stocks, and even some defensive stocks that tend to perform well in downturns. This balance can help you capture both income and growth while keeping your portfolio resilient. In the end, building a diversified dividend portfolio is about finding the right mix that aligns with your goals and risk tolerance. With a well-rounded approach, you can enjoy the benefits of dividends without worrying too much about market ups and downs. Diversification is your safety net, ensuring a steady path toward long-term growth. Chapter 5. The Power of Compounding Dividends. One of the biggest advantages of dividend investing is the power of compounding. When you reinvest your dividends, you're essentially using those payments to buy more shares, which can generate even more dividends. Over time, this creates a snowball effect where your investment keeps growing faster and faster. Here's a simple example. Imagine you own a stock that pays you $100 in dividends. If you reinvest that $100 to buy more shares, next year those additional shares will also earn dividends. Year after year, as you keep reinvesting, the amount of dividends you receive grows, And so does the value of your portfolio. What makes compounding so powerful is that it doesn't require any extra effort. You're just letting your investments work for you. The longer you stay invested, the more you benefit from this effect. So, by reinvesting your dividends, you're taking full advantage of the natural growth that dividend investing offers. Chapter 6: Avoiding Common Pitfalls. Dividend investing can be a fantastic way to build wealth, but there are common pitfalls you want to avoid. The first mistake many investors make is chasing high yields. While a big dividend payout might sound appealing, high-yield stocks often carry extra risks. Sometimes, these companies are struggling, which could mean they might cut or eliminate their dividends altogether. Another pitfall is ignoring a company's fundamentals. It's tempting to focus only on dividends, but you need to look at the bigger picture. Check the company's financial health, industry position, and growth potential before investing. A strong balance sheet and stable cash flow are signs that a company can sustain its dividends over time. Lastly, don't underestimate the importance of patience. Dividend investing is about steady, long-term growth. Avoid the urge to panic sell during market downturns. By staying focused on quality companies and holding your investments, you're more likely to see solid returns over the years. If you found these tips helpful, make sure to subscribe for more investing insights. Drop a comment below with your own dividend investing experiences or questions. I'd love to hear from you. And don't forget to hit that like button if you're ready to start your dividend journey today.